Welcome, everyone. My name is Paul Stevers, and I'm president of Think Renewables Group and co-founder of Climate Solutions Advancement Network. Yesterday, we spoke about the impacts of climate change on human security and the urgent need for climate action on a sufficiently large scale. Due to the lack of capital in developing countries, one area of the world where action on climate change is particularly urgent is in Africa. As a result of the awareness of the urgent need for governments and international aid organizations, several initiatives and programs are now available to incentivize the private sector to invest in climate action in Africa. One key way to incentivize the private sector is to reduce the risk of investing, which is the focus of our panel today. This session is called Reducing Investment Risk to Increase Private Climate Finance in Africa. During this session, our speakers will outline some major initiatives designed to help investors reduce their risk when investing in business and projects in Africa. Our first speaker is Shahdab Qadri, who is our Communications and Sustainable Finance Advisor. She recently completed her MBA in Business and Sustainability at Clubb School of Business at York University and has been researching climate project finance and facilitation initiatives for our organization. She's going to provide you with an overview of some of these initiatives. And here is Shahdab.
Thank you, Paul. Good afternoon, everyone. Let me share my screen. Sorry about that. Okay. So I will be introducing you to selected climate project finance and facilitation initiatives. We will be looking at initiatives by IRENA, International Renewable Energy Agency, Convergence Blended Finance, and then Private Financing Advisory Network, PFAN in short. And we will have speakers later from Convergence and PFAN expanding on them. And I will give you an overview of some initiatives starting with IRENA. So let's look at it. In order to create bankable projects, project developers can actually get access to free information resources and assistance from organizations such as IRENA. IRENA's Project Navigator is a free online platform that provides guidance to assist in development of renewable energy projects. There is a variety of project preparation tools, models, templates available to strengthen a project proposal. And they also have interactive workspace to improve bankable project proposals. For example, provides online tools such as checklists and evaluation forms that can be applied to help structure bankable project proposals. They also have search engine to find financing instruments relevant for specific project configuration. For example, users can screen financing instruments by type of renewable technology and location. You can get information about them in the website shown in my screen, irena.org/navigator. You can register for free there. IRENA also have climate investment platform. So a virtual marketplace connecting renewable energy project owners, investors, and technology suppliers. IRENA and its partners will create opportunities for potentially bankable projects to be considered for funding. One can submit a request to obtain support for project development and or access to finance for a renewable energy project. Again, you can get information about that from irena.org/irena4CIP. Next is Convergence. So it's a global network for blended finance and generates blended finance data, intelligence, and deal flow to increase private sector investment in developing countries. So investors can quickly search databases for credible deals or investors that match their investment needs. It really helps to broaden investors' network and also simplifies their screening process for blended finance deals. It's an online matchmaking platform that connects credible private, public, and philanthropic investors with one another to invest in blended finance opportunities in emerging markets. Finally, PFAN, Private Financing Advisory Network, they help entrepreneurs and investors wishing to invest in developing countries. So they offer free business coaching and investment facilitation, helping entrepreneurs refine their business plans and financial models, thereby making the projects more attractive. Similarly, it also provides investors access to projects in developing markets that they're not familiar with. You can find more information at pfan.net/preparing your project proposals. And PFAN also has listing of investment-ready projects. You can see details about different projects through which is you can get information about their area, their project IRR, and basically you can get all these information from pfan.net/investment-ready projects. So these are the three I wanted to introduce you, and that would be it from me for now. Thank you, everyone, for listening.
Paul, did you want to make the next introduction? Or you might be on mute.
Yeah, so thank you, Shahdab. Our next speaker is going to talk about blended finance with a focus on financing climate solutions. His name is Clubb, and he is Managing Director of Convergence. Chris is a finance executive with 25 years experience in international finance, developing strategies and leading teams to execute private debt and private equity transactions. He has originated or approved more than $30 billion of financing projects in more than 80 countries. As well, he has experience in international finance institutions, multilateral banks, export credit agencies, and global banks. Chris has a master's in finance and a Bachelor of Commerce. Chris, could you please tell us more about Convergence and how it facilitates blended finance?
Great, sure I can, Paul. And can you see my screen? Is it projecting now?
Yes, I can see it.
Okay, thank you very much. Yeah, hi, thanks for the introduction, Paul. So yeah, so my name is Clubb. I have around 25 years of experience of financing projects in developing countries, largely working initially for Export Development Canada, but then subsequent to that, I work for Europe's two largest development finance institutions, European Bank for Reconstruction and European Investment Bank. Just bear with me one sec. And for the last 5 years, I came back to Canada to join a group called Convergence Blended Finance. Now, Convergence is an organization that is 100% dedicated to increasing private investment into developing countries for the purposes of achieving the Sustainable Development Goals. We exist really to do two things. Number one is transactions. What can we do to support a higher number of blended finance transactions, achieving financial close and making investments in developing countries? And then second, we're very much involved in what is called market building, to build a more effective, more efficient, more impactful blended finance market that will ultimately get more funding flowing into these markets. As a headline here, blended finance exists really, as I said, to achieve the Sustainable Development Goals. Now, two major organizations, the UN and the OECD, have tried to estimate on an annual basis how much investment is required in these 145 developing countries to achieve the Sustainable Development Goals. The best estimate is around $4 trillion a year, but actual investment levels are only around 1.4 trillion a year. That leaves what is known as around a 2.5 trillion, sorry, not billion, SDG investment gap per annum. And on the right-hand side here, we see essentially where that gap is. For example, the largest sectoral gap is around 530 billion of investment required annually in the power sector globally. Okay, that divides it into different geographies. And a lot of that really is meant to be done as green and clean as possible. There are other green areas, But broadly speaking, of that 2.5 trillion, best estimates are around 500 billion a year would fall under the umbrella of green or climate investment globally, okay? And the biggest needs are really in climate and SME financing. Now, that sounds like a large number, but the reality is there is around $370 trillion of global financial assets. This is money held in securities, whether they're debt securities or equity securities, deposits at banks, all financial assets. But the problem we have is that only 4% of global financial assets are actually located in developing countries once we exclude China. Now, 81% of that is invested right now as we speak in the OECD or high income countries. That could be Canada, United States, Europe, and so on. Now, those investors look at these 145 countries, and what they use as the barometer of risk when they look at these countries is what's known as the sovereign risk ratings of these developing countries. Not all 145 of them are rated, around 85 of them are rated. And when we look through those ratings from Moody's, S&P, and Fitch, and this is S&P's slide here, what we see is that the median sovereign risk rating, which then approximate towards country rating for them, country risk, is single B. Now, I don't know if you know much about these rating agencies' ratings, but most money that's being managed in the high income and OECD markets has no mandate, no mission, no capacity to invest in single B type of risk. So they largely look at the investment opportunities in these countries and see a risk profile that is unacceptable relative to their mandate. So at the core of blended finance here is the whole idea of, can we deploy some development funds with the absolute intent of achieving development impact, but can we allocate a portion of that with the additional objective of mobilizing private capital to help narrow that 2.5 trillion annual funding gap? And that's where blended finance structures come into play. If we've all taken Finance 101 and we look at debt investment, we see what's known as the capital asset pricing model on the right-hand side. That market efficient line sloping upwards to the right is essentially, these are the investments that a rational, fiduciary motivated investor can make. But when they look into opportunities in developing countries, too many investment opportunities, whether they're individual projects or whether they're portfolio projects, fall below this line. So they're not quote unquote market equivalent. They're substandard relative to market equivalency. And therefore blended finance can do one of two things. It can either reduce the risk, moving the transaction from A to B, or it can augment the return, moving it from A to C. But we cannot expect fiduciary financial investors to be allocating any funding that fall below this market efficient line. Similar logic is true for equity, but I use debt here as the best illustrative example. Now I'm going to walk you through at Convergence. We've tried to scour the world to determine what is the current blended finance market, what does it look like? And we have seen four primary, what we call archetypes of how concessional or catalytic or development money is combined with or blended with private sector funding. And here are the four main archetypes that we largely see out there. The bookend ones, the one on the left and the one on the right, are the primary methodologies to quote unquote alter the risk return to be mobilizing private investment. Around 66% of the projects in our blended finance database that have climate as their primary objective, around 66% of those transactions deploy the capital structure on the left. And what we have here on the left is concessional capital in a gray area. It's essentially money that is coming into a capital structure for one project or a portfolio of projects, where that concessional or catalytic capital is bearing a risk return that is, I guess, higher risk and or lower return than what the market is, for the whole intent of creating a market equivalent investment opportunity for the private sector to make an investment. On the right-hand side, around 34% of these transactions have deployed something akin to a guarantee or an insurance type of approach. Now, we've looked across those 640 transactions also to look at the 17 Sustainable Development Goals. And this is an alignment of where that funding is actually flowing. In general, when we're using blended finance to mobilize private investment must go to a project or a portfolio of projects that have underlying revenues that can be used to repay and remunerate the private sector at a fair market equivalent cost. So you see here that the SDGs where blended finance flows ultimately have underlying sectors and projects that have these types of revenues. We've put in dark blue here, those which are really strongly aligned to climate. As you can see there, when you aggregate SDG 7, 13, and 11 up, you begin to get a very large percentage of the blended finance transactions implemented over the last decade have been flowing to climate-related objectives. Now, when we look at the entire blended finance market, which is the bar chart here, and then we look at climate as a function of the entire blended finance market, we can see here that broadly speaking, the number of transactions in blended finance, that's the bar chart here, is the the bar chart is the number of transactions, yeah. That the number of transactions that have been with climate is around 40%, but the aggregate amount of financing has been a little bit above 50%. But broadly, a rough good rule of thumb is around half of the blended finance transactions to date have been pursuing climate solutions as their primary objective. When we look at climate blended finance transactions relative to the overall market here, we can see climate transactions are the ones that are heavily shaded here versus the overall market, okay? What we have found is that in general, climate solutions have been quite prominent in projects, i.e. 32% of the climate, 32% of blended finance solutions have been in the project area versus 24% in general. So in general, what this slide says is that when we look at the types of blended finance structures out there, whether it's a fund or whether it's a project or whether it's a company, okay, what we have had is that climate has been underrepresented in funds and overrepresented in projects relative to the median or the average of blended finance. Now, when we look at climate blended finance solutions, what particular targets, what particular solutions have they been actually oriented towards? The majority has gone into renewable energy, that's largely climate-friendly generation capacity, and then energy efficiency. And here's the other distribution of where those transactions have actually flowed. Now, moving within just renewable energy and looking at that part of the pie, where has the financing been flowed? Well, solar and wind have been, two of the bigger ones with hydro, and there's been so geothermal and biomass and biogas. But it gives you an order of magnitude of in general, where has been the whole pie chart, and within renewable energy, what have been the primary sectors, subsectors that we've seen. We also have seen that climate blended finance transactions have been larger on average relative to others. When you think of the others are primarily SME financing endeavors and agricultural endeavors, broadly speaking. And it's natural to see that a lot of the blended finance transactions for climate have been larger. So for example, a lot of independent power projects that might be solar or wind tend to have a relatively large size individually. And when you aggregate them into a portfolio and you're trying to mobilize on a portfolio level, they can naturally become a little bit larger. That's important and that's good, because the private investors repeatedly tell us that they want to see size, and size is easier to achieve in climate relative to the other areas. Now, these are the areas, the geographic regions and countries where climate blended finance has flowed. You can see here Sub-Saharan Africa has been the primary area, and that is largely consistent with what the donor or development agency community wants to see. Sub-Saharan Africa is the prime region of objectives of the formal development community. It is true that those countries represent higher risk when you come to sovereign and country risk, and therefore it's a little more difficult to mobilize in general to higher risk countries, and therefore a little more difficult to do it in Sub-Saharan Africa in general. And on the right-hand side, you see the main countries that have been the beneficiaries of these climate solutions. The players involved in the blended finance market, this is an imperfect database. This is an imperfect summary, but it's pretty close to probably what is the reality if we had all of the data. We don't have all of the data. And we can see here on the left-hand side, these are the multilateral development banks and DFIs that are most active. For those of you who do not know, the entity at the top here is the Dutch, a national-owned development finance institution called FMO. IFC is the private sector arm of the World Bank Group, and so on. Blended finance is really only possible through the financial contributions of the development agencies and the philanthropic investors in the second and third column over here. And in the fourth and fifth column, we actually have those that are private financial institutions or investors that are allocating funds in these particular transactions. And when we look at across the entire board in climate-related projects, I don't think that we'd be surprised to see that multilateral development banks and DFIs have been the most prominent investors to date in climate-related transactions. And this is how you'd see the breakdown of the MDBs and DFIs versus development agencies and so on. Once again, this is, we track it by number of commitments, not by the aggregate amount of volume, which we have less visibility into. And here's some examples of blended finance transactions that have been flowing into developing countries. As I said earlier slide, a lot of them are happening at a fund level. Quite a few of them are happening on a project level, and then a little less so on the companies and facilities and bonds levels. But there's lots of precedent. There's probably around 200 blended finance transactions that have been implemented over the last decade or so. And here's some examples. So lots of precedent out there. If anyone wants to follow up on to understand a little bit more about that precedent, invite them really to contact us. With Paul, I'll bring to an end our presentation here.
Okay, that was very illuminating. Thank you, Chris. Thank you for that. One way to further reduce your risk of investing in developing countries is to invest through experience impact funds. In this way, you can benefit from the wide range of experience and expertise of these funds. To provide you with some insights on reducing risks of investing, I'm going to introduce you our next speaker, and that is Serge LeVert-Chiasson. He is the Chief Operating Officer at Sarona Asset Management in Kitchener, Ontario. Serge oversees Sarona's operations, its impact imperative, and compliance work. Serge holds an MSc in accounting and finance at the London School of Economics and an international MBA from the Sloot School of Business at York University. He's also a CFA charter holder. So Serge, please share us some insights on how your firm mitigates risks in its investments.
Great. Thank you so much, Paul, for that introduction. Let me go through, I've got a few slides I wanted to share with the audience. The first one being a little bit about Sarona. So like all great super hero stories, there's an origin story to corporations as well at times. So I thought I'd just share a little bit of Sarona's origin story. Back in 1953, a group of Mennonite refugees landed in the Chaco region in Paraguay and were having quite a bit of difficulty establishing themselves and economically supporting themselves and their family and their local community, which was comprised of a lot of local Aboriginals. So at the time, a number of Mennonite business people from Canada and the US went down to see what they could do to help. And those individuals, after careful discussions with the local community and the refugees, the economic refugees that were there, decided they, instead of giving a handout to the group that was going to come from their local community in North America, decided to make an investment in a company that would support the economic development in that local community. And that initial investment was in a dairy farm that was called the Sarona Dairies. Unfortunately, that company did pay off all of the loans that were given to it, but doesn't exist today, 60 plus years later. But many of the people that were trained and worked at that dairy farm ended up creating their own dairy companies in Paraguay. And approximately 70% of the dairy sector in Paraguay today can be traced back to people who were trained or worked at this initial dairy farm in the Chaco region in Paraguay. I like to tell the story because it tells a lot about how we operate. We make what we feel are impactful investments in promising entrepreneurs through local partners in these markets. And given the patient capital that they need in order to make a sustainable impact in their local communities. What does Sarona look like today? So Sarona has changed a lot over the years. That initial investment was made through a company called MIDA, which is a charity in Canada. But Sarona Asset Management has only been around for about 11 years. So Gerhard Priest, the CEO, and I, who is a COO at Sarona, left MIDA back in 2010 to create the Sarona Asset Management Group. And in the intervening years, we've had quite a lot of new developments, and we'll go through a few of those in anticipation of some of the questions that Paul asked. Just for those of you who don't know much about Sarona, what makes us a bit distinct in the market is that we invest only in emerging markets in Latin America, Africa, emerging Europe, and Asia. We also are an impact investor and have been so since the beginning. We're one of the members of the Investors Council of the Global Impact Investment Fund. We have been a B Corp since 2011. We are also signatories to the Operating Principles for Impact Management since it started, as well as being a UN PRI signatory, one of the first in Canada. And we've also been named on the Impact Assets Global 50 list since its inception. And this year, we were very proud to be named once again on that list. We are a finance-first impact investor, meaning that we do seek to create reasonable rates of return for the risks that our investors are taking, but do so with an impact orientation. And finally, building on Chris's explanation of blended finance, we have been a bit of a pioneer in the blended finance space, initially doing a blended finance contract with Global Affairs Canada and MIDA back in 2013, and doing a second one in 2015. And more recently, we've been working with the Australian government in managing their blended finance fund-to-fund focused on Southeast Asia. Go to the next slide. What are Sarona's investment strategies? So we have three main buckets of activities. We have a private equity program, we have a private debt program, and then we have what are called separately managed accounts, where we work with the clients. These are single investor clients, and aim to invest the capital upon the investor strategy and the wishes of the sponsor or the client. In this case, we have what's called the Emerging Markets Impact Investment Fund, which is the Australian government's initial foray into impact investing and blended finance. We're very proud to be associated with them in the management of that program. We also manage the impact, or sorry, I should say, we advise on MIDA's impact investment portfolio and provide them with the support they need to create value and to ensure those companies and investments are successful. On the private equity program, we have three pooled investment funds. One was a pilot that was launched in 2010, and then we have two institutional funds. The performance has actually been a little bit surprising even to us. In the private equity fund, our first institutional fund, is currently showing a 1.4 times return on money. That represents about an 8% return net of fees to investors in USD. Our last institutional fund that was launched in 2019 has actually seen, even to our surprise, during COVID-19, saw a number of positive developments. Today, we're showing a 1.5 times return on money for investors, which shows a pretty high IRR of 48%, although we do expect that to fall as the investments mature. On the private debt side, we have a private debt offering that started in December, and so far we're tracking about a 6.5% return net to investors alongside the impact. I will now go to the next slide. Here we just to give you some statistics, so we have 4 pooled investment funds where we pool around investor capital from around 330 investors around North America primarily, but also in Europe. We've made 70 plus investments in 60 plus countries, and we currently manage about $325 million through these mandates. We do have an extensive, although the team is relatively small, we're 15 people. We have a pretty large investment team, some of which are highlighted here. If you add up those years, they do add up to quite a bit, about 140 years of private investment experience, many of which has been in emerging markets, and it's a joy to work with such a talented group of people. We have vigorous debates on investments, but we truly respect each other's capabilities, and we're really happy to have such a stellar team to be working at our group. Also trying our very best to represent our impact. We encourage those on the call to participate in or to review our values report, which is accessible free of charge on our website at saronafund.com. There's also more information, our impact theory of change, which I encourage you to review if you have time. We're also part of a pretty diverse network. So Sarona was asked to present today, but I would encourage you to go and check out who are some of the other impact investors in the space. There's over 125 signatories for the operating principles for impact management, for example, of which I think there are 4 or 5 in Canada. There's also 350 plus members of the Global Impact Investment Fund doing excellent work on a number of impact theses in different parts of the world. Many of the B Corps, not all of them, but many are financial service companies. So I'd encourage you to review the B Corp list. And then I am also a proud director of the Canada Forum for Impact Investment and Development that has 90 plus members, many of which are active in doing investments. And we just joined the Asian Venture Philanthropy Network, which includes 600 members, including many impact investors. Now, Paul did ask me some questions here that I have to answer. One of which was, what are the methods for de-risking emerging markets investments in climate mitigation and adaptation? This is probably true for any kind of impact investing in emerging markets. And some of these are perhaps even more important for climate investments. But in a nutshell, these are just some of the ideas that are out there. One of them is portfolio diversification. So Sarona, for example, utilizes a fund-to-fund approach, which allows us to place our money in numerous markets, numerous companies, numerous funds in order to ensure lower risks to our investors. Careful underwriting shouldn't be underestimated. There are a lot of bad investments out there. So making sure you work with someone who has a track record reduces some of the risks that you might do in some of these investments. Chris did mention the concept of blended finance. I won't put too much words around that because it's been well explained, but it plays an important role in terms of de-risking investments. I actually think, and I think many of those on the call probably agree, that doing impact investments in many ways de-risk those investments for the simple reason that typically fund managers and or companies that are doing positive environmental and social changes to the business that they operate are generally superior managers and superior at understanding the complexity of working with various stakeholders. And that creates value in the long term. Layering risk is another one. So we did see a little bit of that in Chris's presentation, the concept of having equity tranche at the top and meso tranche in the middle and more senior tranches at the bottom allows investors to then pick and choose the level of risk and return that they're comfortable with. I often talk also about smart technical assistance. When done well, it can really provide and add quite a bit of value and reduce some of the risks in investments. And then finally, FX hedging is very complicated for private equity and longer term projects like infrastructure investments. But there are some technologies out there and some ideas out there that are starting to become more mainstream, including proxy hedging. Sarona did write a paper on this, so I'd encourage you to check out the paper that was co-written with Crystalis and supported by USAID to get a little bit more information on that. And then finally, I was asked, how do we scale investments in developing countries 10 times? It's quite an ambitious goal. I would say at a high level, improving the business climate is something that's very important. So this is something governments can do. We often talk about the doing business World Bank rankings. Well, that provides a bit of a blueprint for governments to reduce the bureaucracy to do business in many markets. So I'd encourage governments to reduce some of the red tape to make it easier for businesses to invest and to thrive. Contract protection is so critical in doing investments. So making sure that local laws are well understood, are easy to enforce, and courts are fair and just and efficient. We talked a bit about improving the risk return profile through layering of risk strategies in the previous slide. That is true here as well. Withholding taxes is a bit of a sore point for me. Many businesses pay their fair share of corporate taxes, employee taxes, employees pay their fair share of taxes, and then investors that make investments pay their fair share of taxes. Withholding taxes is a real problem, particularly in the developing world, because it stops money from coming in and makes it more challenging to get money out of certain countries. That would be something, if I had a wand, I would eliminate in a heartbeat to make it easier for international investors to support projects in emerging markets. Enabling blended finance is one that we talked about. And then pricing externalities. Canada has had a bit of a political debate about the role and the usefulness of carbon tax. I think the jury is not out on this one. It is pretty clear that the pricing externalities leads to business leaders making smart decisions, particularly when it comes to climate investments. So having a global carbon tax would be quite beneficial to scaling up climate investments in developing countries, in my view. And on that, I will pass it over back to Paul for the next presentation.
So that was very illuminating. Thank you, Serge. I appreciate that. Our final speaker will talk about how advisory and investment facilitation services can reduce investment risks. His name is Boateng, and he is from the West Africa, he's a West Africa Regional Coordinator at the Private Financing Advisory Network, or PFAN, in Accra, Ghana. He has a clean energy finance professional with a varied experience in venture capital finance, banking, and business management. Has direct experience in business plan development, coaching, asset management, and investment advisory. Albert has provided consulting services to clean energy businesses to both startups and growth companies. Albert, please explain to us how PFAN reduces the risk of investments to help SMEs develop investable proposals.
Thank you very much, Paul, for your kind introduction. Please let me know whether you can hear me. I have the signal that my internet connection is weak. Can you hear me?
Yes, we can hear you. We can hear you, but now you're sharing.
So okay. I may have to turn off my video just in case.
Okay, yeah.
Can I go on? Can you hear me? All right.
Yeah, with your hear you, but
permission, I'm just going to turn off my video because it's interfering with my bandwidth. Okay.
Okay, good. And I'll turn off my video as well.
One second, please. Okay, so I'm trying to turn on my video, but it's not working. So I will go ahead, proceed. Okay. So PFAN, as the name goes, is a private financing advisory network. It's a global network of climate and clean energy financing experts, which offers free business coaching and investment facilitation to entrepreneurs developing climate and clean energy projects in emerging markets. Essentially, we are a project preparation facility and financing facilitation program that supports clean energy businesses across the globe. We, as a global network, we have a footprint in most places, especially in emerging and developing countries. We have offices and operations in Sub-Saharan Africa, Asia, Central America and Caribbean, as well as Eastern Europe. So as a network, we are organized as advisors and a pool of investors where the advisors provide the coaching support to projects. And then after they are deemed investor ready, these projects are presented to investors for funding consideration. So our network of advisors are more than 130 in Africa, Asia, and Latin America. So why do we exist? Why are our services necessary in this day and age? to put it bluntly, what's the problem that we solve? We have observed that there is a limited supply of investor projects, not because the projects do not exist. However, the kind of projects that we see in the marketplace are not prepared enough to meet investor expectation. So they do exist, but they are not in the quality and standard that makes them attractive for investor consideration. And this arises as a result of the lack of financial and commercial skills on the part of developers, and also to some extent their expectations for returns on these projects. So PFAN does come in to help them prepare these projects in a way that meets investor expectation. On the other side, we observe low investment levels. Even though there are large financing pools available for such projects, we notice that to some extent, some investors do not have understanding of the technologies that the projects are presenting, and in some cases, the business model themselves. So PFAN does the work of interpreting these projects and their unique situations, idiosyncrasies to the investors, thereby sort of presenting the project in a way that they understand the return expectations. And then with that, investors find, with that work done, these projects are reintroduced and presented to investors for funding consideration. We do support investors in also conducting due diligence on these projects. With our network, who are mostly locally based advisors, they have market understanding and knowledge of both the projects and the countries that they are located in. So they're able to also help investors in assessing and conducting due diligence on these projects. In essence, PFAN advises low carbon, climate resilient businesses in developing countries and matches projects to appropriate private financing. How does PFAN work? Like I said earlier on, our services are free, unlike elsewhere where developers would approach a consulting firm or advisory firm and pay for their service before any support is extended. PFAN supports these projects and makes these supports available for free. The investors or the advisors make fees based on fixed deliverable schedule, such that the developers don't have to make any upfront payment until such a time that projects achieve financial close. And that's the only time that the projects pay something, and usually it's a token to the advisors. We are supported by an extensive network of investment and network partners. The investment partners are those investors that offtake projects from PFAN, and the network partners support program activities, one by helping to do outreach in originating projects and helping PFAN promote its activities. PFAN is hosted by UNIDO and REAP, United Nations Industrial Development Organization. Both are headquartered in Vienna, Austria, since 2016. The program itself started in 2006. We have a unique and proven low overhead network working business model, in the sense that we don't have full-time employees. Our advisors are contracted as and when there are projects to develop and support. And so we have a low fixed overhead. We are funded by a multi-party trust fund that includes a host of governments, Sweden, Australia, and some development agencies such as USAID, and then some programs such as Kigali Cooling Efficiency Program. What is our track record? We mobilize financing to reduce GHG emissions and contribute to the Paris Agreement and Sustainable Development Goals. The relevant ones being SDG 7, 9, 13, and 17. Over the period, PFAN has supported nearly 1,000 projects, with more than 300 projects in our current pipeline. Up to date, we have been able to mobilize close to $1.85 billion worth of investments, supporting 159 projects. These are projects that have been able to raise financing, and the number keeps on changing with a success rate of 17%. In all, we've been able to add new capacity of 1,159 megawatts, and thereby in the process reducing CO2 emissions by 4.1 metric tons. This is our organizational setup. As I said, the executing agency is UNIDO, manned by a program manager and a partnership manager. And then REAP, Renewable Energy and Energy Efficiency Partnership, is the implementing agency. And together they are organized under the umbrella of a PFAN management unit that is overseen by a steering committee that has one of the donor governments chairing, in this instance, Sweden. We, as a network of advisors and investor partners, the program is run and managed by, headed by a PFAN global coordinator with support provided by an investment facilitation team that really comes in to support the work of advisors when it comes to presenting projects to investors. So what process do we go through? What's the PFAN process to originate and then finally introduce projects to investors? So we have an open-ended call for proposals that is currently ongoing, open-ended call for projects. So any developer that has a need for advisory support and project preparation can go to our website, www.pfan.net, and follow instructions to apply for our services. These projects are screened, the applications are screened and evaluated, and the qualifying ones are selected for contracting, where they are assigned to expert consultants on the ground to begin the process of refining and improving the business model and other project deliverables. So the coaching continues for a period of 3 to 6 months, the refining. And then when all the development package is seen to have been put together, we begin the process of introducing the projects to investors. So this is not a case of one size fits all. We match make, which means that we do due diligence work to see which projects are suitable for which particular investor, and then we hold investor fora and then invite investors to come in and listen to projects pitched to them. And then after that, they then decide whether they want to have further conversation with the projects. Then we have what we call tipping point technical assistance. This is a facility that enables projects that are deemed attractive to the investor, but that requires validation in terms of in some respects, studies that need to be validated before the investor commits to holding further discussions. PFAN provides not only the technical assistance, but some funds such that the project may be deemed to be worthwhile for considering. Fund the projects where in this case we reach financial close. That's the point that PFAN signs off. So we participate in the whole process from project origination. We accompany the projects up to the point where the investor signs up a check and then invest in the project. And we help both the investor and the developer in negotiations in the interaction process. So, I mean, we support several technologies and sectors, and these are just a handful of them. We support agriculture and agribusiness, cooling projects, energy efficiency and demand reduction, renewable energy, of course, climate change adaptation projects. We continue to refine this envelope as new technologies become available and then are seen to be sort of winning over the new technologies and become available, and then we see that investors have interest. We develop capacity to sort of provide additional support to such technologies, and by way of helping developers who are now making use of these technologies in their development and deployments. So this brings me to the last section of my presentation that answers the question how PFAN services help to mitigate investor risk. First of all, the first point is project selection. We contribute to that project selection and making sure that the projects that are selected for support at least would meet an investor expectation. Ordinarily, for funds and financial institutions that show interest in investing in certain regions, the processes of finding the right project is quite tedious. Oftentimes, you have projects knocking on the doors of investors and funds, and then most of them are turned down, and that's quite a waste of time on the part of these funds and financial institutions. So PFAN does the dirty work, which means that you only get to see projects that are considered worthwhile for investor presentation. We also conduct assessments of investment potential, again limiting the number of hours that an investor would conduct to do their own. This does not suggest that we take up the space and the investor doesn't do anything at all, but at least we help contribute to that process and thereby reduce how much time and resources the investor then has to spend on it. Again, we participate in project preparation. I mean, that's the bulwark of the work that we do. And we are an independent, unbiased broker in contract negotiations. So from start to the end, I mean, up to the point that investor enters the fray, we make sure that all contracts that developer enters into are worthwhile are taken with due consideration, so that they don't do things that ultimately may affect the investor that might come in at a later stage. We provide validation of business plan, including risk identification and mitigations. I see that my time is coming up, so I'll just rush through the next few slides. In the process, we also contribute to elaborate and optimize the business model and financial structure. This brings me to my last slide. Hello? Okay, so since we work with locally based source advisors who have access to projects and are familiar with the countries in which these projects are located in, they are quite knowledgeable not only in the current economic, social, and regulatory issues, but they also can bring value to the table in respect of the projects they support, because they make use of local network and also their own skill set developed and acquired in the process of working as advisors. The knowledge bridge points here that I also want to, the other bits about bridging the knowledge gap is also sometimes building the capacity of investors. So we help in some cases, investors come in that show interest, but they may not have invested in a particular country or geography before. So we can, bring them up to speed, and then advisors help with in some respect to build capacity, especially if they are new to technologies or business model. That's one area that advisors can provide support. And finally, I already talked about the tipping point technical assistance that we help to provide to projects that are near investor ready, but for which investor may require additional studies or audits or due diligence before they commit or before they show interest in pursuing these projects. So these are some of the things that we do to, first of all, reduce the amount of time that investor would have to spend on the project. That's not to say they won't do their own due diligence work, but at least we screen these projects and make sure that they are fit for the investment strategy of these investors before we showcase and present them to them for funding consideration. I will bring my presentation to an end here, and then hope that if there are any questions, I may be able to provide you with the answers. Thank you, Paul. Take it over.
All right, thank you very much, Albert. That was very helpful and illuminating about all the different things that you guys do. So now you guys can the speakers can turn on their cameras, and we have a few questions that have come in, or several questions that have come in. The one thing that I liked was when Serge was talking about his thoughts of really scaling up. You know, that in Chris's presentation you talked about a shortage of money that's needed. So compared to where we are on climate finance today, Chris, and if you're going to do a 10 times scale up, what are your thoughts? What kind of things that is going to be needed to make it so that the private sector is coming in at a much higher rate?
I think it's a great question. So just to be clear, this is a question which Convergence is currently dealing with USAID and with the UK version of USAID called the Foreign Commonwealth Development Office. UK is hosting COP26 in November. So Convergence donors and investors have really been collaborating along this idea of, hey, blended finance is not achieving scale. We don't have institutional investors investing at scale. What needs to be done differently? So as a starting point, if blended finance wants to be mobilizing investors of a certain type, and those that really have the substantial money, let's call them institutional investors. The institutional investors are sending a very clear signal to the development community. Look, we don't want to be writing a ticket size less than 100 million because we have to go through due diligence, i.e. our investment needs to be 100 million or more. And we don't want to hold economic exposure of more than 20%, i.e. blended finance vehicles should be 500 million or more. Okay. Now, naturally, the blended finance community, development finance community is not creating vehicles of 500 million or more. The median size has been 65 million. Okay. So that signal needs to go clearly through to the development community. If we want the big money from the institutional investors, these vehicles need to be 500 million or more. And there's really two ways to do this. One way is to have an individual blended finance facility for climate that would be 500 million or more. Or, you know, Serge talked about this whole idea of a fund of funds. You know, you could have a fund itself that raises, let's say, $1 billion of funding, and then it has a fund manager, which in turn is making investments in, let's say, 10 smaller blended finance vehicles. And each one of those vehicles, you know, might get an investment from them of 100 million because there's a 200 million there. So that is not happening right now. So if we really want to get this investment at scale, we really need to be creating the size of vehicles that will attract the real money that's out there. Because right now, predominantly, blended finance has attracted money that is from, quote unquote, the impact investor world. The benefit we have is more traditional fiduciary investors are becoming impact investors as we go. But, you know, we're not there yet. So that is one thing. There's a couple other things, but I'm just saying that is something that we need to be doing differently.
Yeah, and now what comes to mind as well is that but we also need a lot more proposals then that are investment ready. So it's the kind of things that PFAN is doing, that it's almost like that PFAN's activities has to grow by about 10-fold. Would that be a safe assumption there, Albert, that what you guys do is providing real value to the investors in terms of having investable proposals, but you need a lot more capacity and funding to make that to create 10 times the number of money flow, you might say, that would go to these new institutions that Chris is talking about. So if these things were decided upon and created at COP26 and they said, yes, we're going to do it now, then we're going to have a real scale up of what Albert is doing. And people like that. I noticed there's some impact funds that have their own advisory services too. But I think that has to happen on a big scale. Would you agree there, Albert, that if you're really going to scale, that's what you would do as well?
That's correct, and I agree with that. So we've had discussions with some investors that have said, look, the ticket sizes, just like Chris just referred to, are too small. And then what we are trying to do for them, they have an interest in the region. So we're trying to, you know, have a portfolio approach to presenting these projects. So we, instead of just going to them as we currently do from time to time when we have a project that's ready, we are organizing thematic calls that would sort of pull together projects of a certain type, size, and capacity in terms of megawatts. And then we are presenting them so investors can consider them on a portfolio basis rather than looking at individual projects, because sometimes, especially in Africa, the ticket sizes are too small and then they may not be found to be attractive to most large institutional investors.
Yeah. Okay, well, that makes sense. Now we're out of time here. I had several more questions I wanted to say, but we've got running out of time. But it was really brilliant to hear from all of you, and I really appreciate your time, and certainly for the audience